Welcome to the Master Passive Income Show. My name is Dustin Heiner, and I'm here to help you get financial independence, quit that JOB, that just over broke job, by investing in real estate so you never ever have to work a job again. And today I'm bringing on a fantastic expert who has literally been investing in real estate a little longer than I have, which is to say a lot. And with that, we're going to talk about the market, about investing, about the interest rates, economy, everything. And you're going to learn a lot on how you can invest successfully to become financially independent and successfully unemployed. All right, let's start the show.
Welcome to the Master Passive Income Podcast, where we talk about investing in real estate with a special focus on making enough money so you can quit your job and live the dream life. And now, here is your host, Dustin Heiner.
What's going on? Super blessed, as always, to have you here on the show with me. Now, I'm breaking away from our family. This is Sunday afternoon, Sunday evening. So my family, what we've been doing is we've been doing Sunday afternoon game nights where we get lunch and pizza and buffalo wings, and then we play games. Well, we've been playing forever the game Risk. You guys have probably played it once in your life, maybe played it once in your life. Usually you don't play it much after that because it goes for hours, like literally hours and hours and hours. And man, actually, my wife from the very, very beginning it's hilarious, but at the same time, kind of irritating. We get set up. I'm in Australia. You know, that's a really good spot. Only one little area that's can attack you from there. It's not the best spot for the most pieces that you get, but you're fortified. You only have one spot coming in. Well, my wife is literally right next to me. So I get all of Australia and she's like, I'm going to take him out. From the very beginning, she starts attacking me and taking all of my pieces, and I fight back. And then I'm also in another place like North America, and my daughter's attacking me. So needless to say, I got beat out pretty quickly. It took about 4 or 5 hours before I got kicked out, but they're still playing. It's been 4 hours since I got kicked out. And my kids are saying, we're never playing this game again. And they don't want to quit though, because they don't like losing. You know, they're a Heiner. They don't like losing. And because they're occupied right now playing that game, my wife's still in it, I am like, you know what? I got plenty of time. Let me go and talk to you. Now, there's something I've been kind of thinking about for a while. And I want you to really think about what type of content you like to hear on Master Passive Income. So there's two types of content that I really like to put out. Number one, well, actually, the entire show from the very, very beginning, it has been my content, like literally teaching you how to find property managers, how to build the business, how to be successful, how to invest well so you make money every single month and hopefully get financial independence. So from the very beginning, it's always been my content literally teaching you. But then, because I've been podcasting for, 5-6 years now, I've met so many fantastic investors. In fact, created the Real Estate Wealth Builders Conference because I have so many fantastic investor friends, and we all bring our audiences together and create one big community, which is amazing. Check the link in the description if you want to come hang out with us, get 10% off as well with the link in the description. But with that, I also have been getting people who want to come on the show and talk about real estate. Now, I love it. It's fun. I love meeting more people, but I want to know, what do you like to listen to? Like, what type of content do you want to hear from Master Passive Income? Like, genuinely, like if you want me to do more teaching, I'm 100% all for that. In fact, I have a series planned out on how to be a really confident and successful investor. That's really it's much more about what you need to do in your mind, like changing yourself. So I have that all planned. It's like 8 episodes. And with that, I've also realized that I do enjoy bringing people on and interviewing them to get their perspective on how to invest in real estate. Now, the episode that you're going to hear today is a great episode where I interview an investor who's been investing since 2000 or 1999, where I started investing in 2006. And so he's investing longer than me. And we talk about the market, the economies from 2006 to now, like similarities. And we actually have some disagreements. Or I wouldn't say disagreements. We actually have points that we present to each other, as well as we have counterpoints. You know, we're not disagreeing. We're just saying, this is what I see. And so you're going to get a lot more dialogue in this type of episode. So I want to know, and there's a way that you could actually reach out to me and tell me. So I want to know, what do you like? Do you like more content? Do you like a mixture of both? Do you like it coming where I'm interviewing somebody else? Or do you like it where I'm just literally teaching? So actually, this is probably the best way. on Instagram. Find me on Instagram. I would appreciate if you follow me. I love being able to share all this real estate investing stuff with you on there as well. But the Dustin Heiner, THE Dustin Heiner, follow me on there and then send me a DM. I love getting DMs. In fact, that's communications, like one of my love languages. I love communicating with people. And with that, just let me know, what type of content would you rather have? Maybe 50-50, 75% somebody else, interviewing somebody, 25% me, or whatever it might be. Let me know, because it really helps me. I want to help you to invest in real estate. And that's my ultimate goal. In fact, if you guys were at RubeCon last year, I unveiled my goal was to help 1 million people to invest in real estate and hopefully become financially independent. And hopefully you are one of them. In fact, I love also getting DMs from people who, after just listening to the show, started investing themselves and literally started buying properties. And you've heard quite a few of these interviews I've done recently. People are reaching out to me on Instagram. So definitely reach out to me. I would appreciate if you follow me. It's fantastic to get more and more people investing in real estate. Now, with that, I am pumped to bring on a fellow real estate investor who has done lots of different types of investing. And he's a business owner like I am. You start out as an investor, but then you realize what you do is you own businesses. And those businesses have inventory, or you produce a service for your customer. And once you have that, once you realize that in your, financial independence journey, or whatever you're doing in your life to basically get into real estate investing and changing your life, then you'll realize, I own a business. And then hopefully you quit your job and have 40 plus hours of your life, and then have 40 plus hours to put to your own business. Then you have more businesses. Hopefully you'll get to 4, 5, 6, 7 businesses that are all running themselves, just like I do, and just like my guest. And I'm bringing on another investor who we are going to talk about the economy, interest rates, how to invest successfully. And you're going to get a lot out of this episode. I know you will. Let's jump on today's show where I interview Greg Dickerson, who we are going to talk about how to invest in real estate successfully with high interest rates and a crazy market. All right, here we go. Greg, thanks so much for being here.
Hey, thanks for having me, Dustin.
Now, this is great, Greg. Now, I've seen you on other things like your YouTube channel, as well as I follow a gentleman that does stocks. And I was watching what he was doing. I saw you on there too. And I was like, oh man, this is cool. It'd be great to talk to another real estate investor. This other gentleman is not real estate, stocks. But I was like, man, I just love talking to real estate investors, and people have been doing it for a while, because when you do real estate investing for a while, eventually you start realizing that there are more ways to invest. Like, I love residential, 4 units and below. That's so amazing. I love it because it's just cash flow all the time. But there's other great ways, which you've got into. But anyways, I shared a little bit about what you've done in the past, and you also started, when I started back in 2006, started investing, but you started a while ago, just like I did. Talk to us about how you got into investing in real estate.
Yeah. So, 1997 is when I started. So a couple of things there, like on the stock front and things like that. I do have people I work with that are, investing in stocks, markets, crypto, things like that, because you want to be that complete investor, right? So whatever you're doing, for me, it was businesses. And we'll go over my journey. I was investing in businesses first. Then I used the cash flow to invest in real estate. It used to be that real estate was the number one wealth creator, created more millionaires than any other vehicle. Now it's tech. Well, actually, it's finance. Finance is number one. Tech is number two, real estate's number three for the creation of most millionaires. But real estate is the number one where wealth is stored. And there's a lot of reasons for that: tax benefits, leverage, all these different things. And the reason that the financial industry has surpassed real estate is because the bull market we've been in for the last few years, especially post 2020, a lot of upside in the stock markets and crypto markets. And what I do is I work with a lot of people that are exiting that, getting into real estate and helping them, kind of understand what they need to be investing in and, those types of things. But anyways, my story short, I didn't go to college. I joined the Navy right out of high school, 1985 to 89. I did retail in the Navy. And after I got out of the Navy, I did restaurants and construction. The only two things I ever did. I started hauling lumber on job sites, and I was, bussing tables and washing dishes in restaurants. And I ended up working my way into management, became a regional manager. And I always had a little construction business on the side. I started by working for this one guy that was doing an addition on a restaurant. And I went and started cleaning up, behind him on the job site. He's noticed I was a hard worker, said, hey man, I'll pay you to come clean up behind me. And I was like, okay. So that's how I started learning construction while I was working in restaurants. Fast forward to 1997, I moved to the Outer Banks of North Carolina. And I was going to open a restaurant. I worked in the restaurant industry down there for one season and decided I did not like very short season, couldn't get any help. People, it was a difficult time. There just weren't any employees down there, kind of like it is now. So, I had bought a house and I was trying to get some work done on that house and nobody would call me back. I was trying to do an addition, get some landscaping done. It didn't matter what it was. Nobody would return your phone call. This is 1997. So I start talking to my neighbors. I'm like, what
sounds
the heck
like
is
today.
Up with
it's
people?
the same thing happening right now.
I'm like, what is up with people? Why won't anybody return your phone call? They're like, it's so busy that people just literally, they do a job, they go home, answer the phone, they go to the next job. Where there's a problem, there's an opportunity. So I said, you know what? I got some skills. I don't want to do this front thing. Why don't I start a little handyman company, remodeling company, and do little projects like I'm trying to get done, like people are trying to get done that nobody will do. So I went and came up with a name, Outer Banks Construction. I went and registered it at the county. Nobody had that name. Made it sound like I'd been there forever. Then I started putting yard signs and newspaper ads all over the place, started knocking on doors, talking to all my friends that had businesses, saying, hey, Greg Dickerson, Outer Banks Construction, I'll do anything. What do you need done? I'll change a screen, change a light bulb, build a deck. What do you need done? So I started in 1997. First year, I did $250,000 in sales. 7 years later, I was one of the largest builder developers in the area. We're doing $30 million a year in building. I exited that company, reinvested all that money into other real estate development deals, scaled from there. I started 12 other companies along the way during that time period from 97 to 2004, 2005, when I exited that company, But my whole thing was I read Rich Dad, Poor Dad. And what I got out of that book, a lot of people read Rich Dad, Poor Dad, and they get real estate out of that book, right? They want to be like Robert Kiyosaki and Kim, and they want to invest in real estate. What I got out of the book was Rich Dad. I wanted to be Rich Dad. He was the guy that had all the businesses. He's the guy that everybody came to with deals and opportunities. He was the guy that was mentoring everybody. I was like, that's who I want to be. So that's what I did. I went out and started building and buying companies and reinvesting those profits into other assets, and was mentoring and coaching people, helping other people grow companies with me as partners, as sometimes as an investor, as an owner. I didn't run any one of the businesses. I kind of ran them all through other people. And then I reinvested all the profits in real estate and just kind of scaled from there. Started with one little lot flip. Then I started building spec houses. I started buying and renovating. I started building commercial buildings. I started doing land development, like subdivisions, neighborhoods. And then I started doing, did some multifamily, did some storage, industrial, I was in a very small, limited geographic region. So I did a lot of different types of things, from business and, really and stuff like that, because I didn't want to travel. I wanted to be there for my kids. During that period, when I was doing all of those things, building all those companies, growing and selling my company, I was at every event that they had at school, never missed anything. I was home every night for dinner, and I was home, every weekend. We took, 4 weeks a year vacation. So, a lot of people that this hustle culture that we're in now, that think you have to go 24 hours a day and all that. When I started my entrepreneurial journey, that's when I was able to own my time and, set my own agenda, set my own rules, and be there for my kids and my family. So that's my journey. That's me in a nutshell.
That's awesome. Hey, so I didn't want to cut you off because I wanted to hear everything you're saying. So I think your microphone is hitting your zipper. So it's making a lot of noise in the background. So just kind of keep an eye on that. But love it. And what I've found is that for me personally, even though I'm an investor, I invest in real estate. What I really am is I'm a business owner. I mean, that's really what it comes down to. Being a business owner, you actively have inventory, like properties being your inventory. And so my inventory for my real estate is my properties. That's my inventory. And I have the product that I need to lease out, rent out to people. Same thing with other businesses. And what was so amazing was when I was blessed to be able to quit my job, I think I was 37 years old. I quit my job. And then I realized I love working, or I love being active. I love doing things. But then I also thought, you know what? I could do so much more with my life, 40 plus hours of my life back to me, that I could then build my own businesses, spend with my kids, do everything that I want to do, as opposed to working for somebody else. So the faster, if anybody as fast as they can get out of working for somebody else, then you are now back to putting your own time and value into yourself. So I love that. Now, talk to us a little about, so you started back a while ago, as well as through the crash in 2008.
Yeah. So on that note, so can you hear me okay now? I set
can.
the microphone down. Good. Yeah. I know
Yeah.
that zipper thing, man. That's annoying. I apologize for that. So on that note of, working for somebody else. So there are some jobs that are like a business. So what I always tell everybody is, have your own business, your own investments so that you can, compound that and reinvest. But for some people that earn a lot of money, 2, 3, 500,000, million, $10 million a year, there's a lot of people out there that have salaries like that.
And I want to pause for a quick second and share that honestly, I really want you to invest in real estate. Now, my new goal is to help 1 million people invest in real estate. So 2 things I would ask from you. Number 1, if you get anything out of this episode, please share it with somebody else. Just say, hey, check out Dustin and Master Passive Income. He really wants to help 1 million people to invest in real estate. That's number 1. Number 2, I want to get you to invest in real estate. Get my real estate investing course absolutely for free. Text the word rental, RENTAL to 33777. Rental to 33777. I'll literally give you my course, show you how to find an area of the country to invest, how to build the business first. I always talk about that, and how to find the right properties, how to make sure you're getting experts to do the work for you, and scale the business to where you're making $250 or more in passive income. Scale it to quit your job. I'll literally get to you, or go to masterpassiveincome.com/free course. Obviously, it'll be in the description, but I really, really want you to invest in real estate, because the more that actual normal everyday people own real estate that are good landlords, the better everybody's life gets.
Think of it as a business. That is your business. Use that cash flow to invest in other assets from that W-2 job, that business, into other assets that will, number 1, reduce your tax burden. You become a real estate professional. You can eliminate W-2 taxes and real estate gains or other capital gains. But think of it like a business and use that to invest in their assets to get out from under other people. I work with a lot of high income earners, medical, dental professionals, professional athletes, and that's what I help them do. I help them understand what they're doing now is their business, and then invest in these other things in a tax advantaged way so they can escape that W-2 and then get out there and live life on their terms. But didn't mean to interrupt, but I wanted to kind of put that in there.
Oh, absolutely. And when they're making money, they have taxable income that they need to hopefully get rid of, meaning taxes. They don't want to have that taxes. But the great thing about real estate that I love is the more that you see that you're going to be taxed. I'll give you an example. Recently, I called up my accountant. I said, hey, how much am I going to be paying in taxes this next year? Next tax season. He said a lot of money. I'm like, oh man, he gave me a number I'm not going to share. But I was like, oh man, that's a bummer. So what do I do? He said, start paying expenses now and start buying investments. I'm like, okay, done. I start doing that. So I started, like on my conference, I started paying all the bills now. That's going to be happening next year. Started buying properties, investing in that money. What's great is the government's going to penalize you for keeping that money, but it's actually going to benefit you if you actually spend that money on things that make you more money, which is absolutely amazing. Now, I see some similarities from 2008 crash to now with run up of everything, people saying you better buy now or you're never going to be able to buy. Do you see anything similarities from 2006 and 7 and 8 with that run up and then the crash to now? Or do you think that, hey, we're just going to keep going? Like, what are your thoughts about this market now?
Yeah, so we don't have the conditions that we had in 08, 09 for a crash like we had in 08, 09. That was a very different environment. You had a normal level of inventory. You had very bad loans. You had high interest rates, things like that. It was very, very different, climate back then. Right now, in the residential market, most of the borrowers are extremely healthy. They have sub 4% loans. 40% of the houses are owned free and clear in the residential market. There's no inventory out there, right? I mean, we're 1 million units short in terms of housing inventory of what you would normally see in a healthy, housing market. So the residential market.
Hold on to that thought. So I hear that from realtors all the time that the inventory is low. Well, realtors love telling you about the inventory. That honestly, in my opinion, that doesn't matter. What matters is demand. There's no demand for it. Interest rates are so high now. I know Fed said they're going to be much more dovish, where they're actually going to be backing off on the interest rates, but there's no demand. Because they cannot. I'll give you an example. Phoenix, Arizona.
Well, before you get into that, let's qualify. So real estate's hyper local. So there's like La Jolla, California. I just saw a house out there that I'm watching. That one of my guys is flipping houses. There's a $3.5-4 million house, went under contract with multiple offers in days. Sold in days, multiple offers over asking price. My market where I live, there's no inventory. So when the houses hit the market, there's multiple offers. They're selling in days. Interest rates have come back.
Where would that be? Because I'm looking in Phoenix, I'm literally seeing hundreds. Like when realtors say there's no inventory, I'm like, I go on realtor.com or like look up the MLS. There are hundreds and hundreds, some about thousands of properties. Let's make this year your best real estate investing year ever by coming to the Real Estate Wealth Builders Conference. And the Real Estate Wealth Builders Conference is where you can join hundreds of real estate investors and over 40 expert investor speakers and learn how to have an amazing success in your real estate investing business. The Real Estate Wealth Builders Conference is not like any other conference out there. This is a no sales pitch conference where the entire 3 days event is all about you and helping you to meet expert investors, teaching you how to invest and join a huge community of hundreds of like-minded real estate investors. And because you are a part of the Master Passive Income podcast, I'm giving you 20% off your Rubicon Pass. That's right. Get 20% off of your Rubicon Pass by using the promo code MPI20, MPI20. You need to be at the Real Estate Wealth Builders Conference. Join us in the heart of downtown St. Louis, March 14th through the 16th for a transformative 3-day event that's more than just a conference. It's a community of investors. Get your pass. Go to rubicon.com, REWBCON.com, and use the promo code MPI20 to get 20% off of your Rubicon Pass for sale.
So that's Phoenix. Now I have some clients in Phoenix. There are certain pockets of Phoenix where properties are selling in days with multiple offers. So it's not all of Phoenix. It's only certain areas of Phoenix. So yeah, Phoenix, Austin, Texas, probably Las Vegas, those markets have corrected the most in terms of lack of demand and things like that. A lot of that's price point. So when you look at price point, that makes a big difference. So yeah, across the country, every market's different. And then there's, even in markets, there's different pockets, right? So I say every state's different, every city's different, every neighborhood's different, and every street in every neighborhood's different, and every position on that street in every neighborhood is different, right? So real estate is a very hyper-local thing. Now, it can become a nationwide problem like we saw in 0809, because again, that was a bad mortgage situation where, mortgages were going bad, banks were failing, rates were rising, and there were a lot of strategic defaults because people were getting loans with no documentation, no verification. They were getting, negative amortization loans, all these, different, they call them liar loans where you don't have to prove income or anything like that. You just had to have a good credit score and it didn't even need to be yours, to get loans. It was crazy. So now underwriting is very different. The borrower's very different. The interest rate environment's very different right now. And in most areas of the country, there is a lack of supply. So yeah, you need demand in order for supply to matter, right? Just doesn't matter how much there is of something if there's no demand. The other thing that's happening is now 10 years coming back, interest rates are coming down. They're back almost, if not already, under 7% again. So that now that 7% threshold is kind of that psychological threshold to get people off the fence. Whereas back in 0809, it was 5%. Remember, if rates went up above 5%, the market would cool. As soon as it dropped back down, it started stimulating. The other thing is, even when rates were 8%, you could get buy downs, you could get interest-only ARMs. Builders were buying down and offering different, mortgages. Right now in Denver, Colorado, I think it's, I can't remember which one of the home builders, Horton or somebody like that, is offering 4.75 30-year fixed loans. There's also mortgage products now to where you can go in at a higher rate, but you can adjust that long-term 30-year fixed rate down if rates drop. So, there's a lot of mitigation of interest rates out there. Of course, it's seasonal right now too.
Those mitigations of interest rates, I've seen it where, in fact, I was talking to one build-to-rent builder, and they literally have to charge 10% on top of what the actual market value is because they have to pay down the rate. They're like, oh, we'll get you a 4.5%, but I'm paying for it up front. But I completely understand. I know what you're saying. I think it's never the wrong time to buy in real estate. There's wrong deals, the wrong properties that might make you go bankrupt. But it's always going to be the right time. Now, how do we utilize let's say we have low inventory and we have a high interest rate? How do we utilize that for us to, as investors, to buy and make sure we're making money in real estate?
So it depends on what your exit is. So you can pay anything you want for a property as long as it meets your return requirements and your exit strategy. So if you're buying cash flow properties, well, what is your goal? Your goal is passive income. So you need a spread. So you have to do the math, reverse engineering. You got to have that spread that you're looking for if you're going to rent it out monthly. Or you might be okay with just breaking even and the house pays itself off and you own a bunch of houses free and clear down the road. So it all depends on what your strategy is. If you're a speculator like me, opportunistic developer. That's what I've been my whole career. I don't like to own and rent properties. I like to build and sell and compound cash. Cash is the best tenant you can ever have. Never complains, never doesn't pay. You know what I mean?
Well, that's how banks make money. That's why they are the wealthiest.
I've always been a landlord of cash. So I would build properties, get them stabilized, and then sell them. But I don't like being a landlord. I like being a landlord of cash and compounding. So my strategy, I have to be very in tune with what you just said. Is this market that I'm going into, is there demand? Is there demand for what I want to bring to market? What does that look like? What happens if the interest rates change on me? Because that's going to affect values. So that's where you really have to become an expert at what it is you're going to do. You need to have your exit plan in mind, and you need to have multiple exits. So just because I want to build and sell doesn't mean I'm going to sell. So I always go into an investment thinking it's not going to sell and I'm not going to make any money. And if that happens, is that okay? And how much could I potentially lose? And if I do see that come to fruition, can I, absorb that loss? So the biggest mistake people make is they don't accurately calculate the risk, and they're not able to withstand the hit when that comes through. So you got to make sure you understand those. So if I can't sell, I can rent. Well, how can I rent? I can do long-term, I can do midterm, I can do short-term. Well, is that allowable in the markets that I'm in the neighborhoods I'm in the areas I'm in? What are the costs and licenses and permits and rules and regulations associated with that? What are the tenant laws, associated with the areas I'm in? In California, they're passing new tenant laws now that are very, very friendly to the tenant, to where you can't evict them, you can't change the amount of rent they're paying. I mean, I can't remember all the details, but very prohibitive details in California on what you can and can't do with raising rents, evicting people, all these different things. You got to be very in tune with where you're investing based on what your strategy is. But it all starts with, you got to become an expert. You got to know your market. You need to know the type of strategy you're going to use, and how to mitigate risk, how to accurately calculate that risk and mitigate it.
Yeah, I think that's a great idea. And knowing what the risks are, number one, and then knowing the options of what you can do. Because if you go into only having one strategy, then you might get stuck. But having experts around you, getting a mentor, getting a coach, that's really helpful, because hopefully they're going to know all the different options out there. And they're going to help you understand these are the things that you can do. You got to pick what's best for you. Now, with the inventory, I want to quickly go back to the idea of inventory. And man, my rents have just skyrocketed. And so the other side of inventory is rental inventory. My property prices are obviously the prices have gone up, but I make so much more money in rent now. And the reason why is because they say, well, it's very low supply of properties, and there's more people who want to rent. Well, here's what I'm absolutely saying. I want to get your take on this. So the low supply of properties for people to rent long-term is very, very low. But here's another reason why, or the reason why I'm seeing. So before Airbnb, VRBO, all these properties were long-term properties. And people, when they vacation, go to hotels. Now, if you look in, let's say, Phoenix, there's like 70,000 Airbnbs. And so those homes are literally taken off of the market and put for long-term and put only for short-term. I think that can be potentially a big problem for saturated with all these Airbnbs. But I see that that's another reason why demand is so low. Demand is so low, and the supply is so low for these properties, is because Airbnb people are snatching it up. But what are your thoughts about that? Because there's so many Airbnbs now that takes off our long-term properties that we can buy.
Yeah. So the demand is high for long-term rentals, but the supply is low.
There you go.
That's what you're saying. Okay.
Yep.
Yeah. So short-term rentals, and that's why Phoenix, Las Vegas, Austin, Texas, that's why those markets are correcting, because a lot of people bought those thinking they were going to do Airbnbs. Because remember, during the pandemic, you could put an Airbnb anywhere. You could be in a cornfield in Iowa, put a little shack out there, and people would rent it because, hey, I've never been to a cornfield in Iowa. I can't go anywhere. Let's go check it out. So as soon as the world opened after the pandemic, Airbnb came under pressure. Now, I started in the short-term rental industry. So I was on the Outer Banks of North Carolina. That was a summer vacation destination. That's what it had always been. That's what it's always going to be. There's a very small percentage of a year-round population there, and a small percentage of year-round houses. And they're having a shortage there because that short-term rental market is absorbing all those units, because you can make so much more money. The other thing is midterm rentals are really absorbing a lot of inventory as well, because that's for traveling nurses, executives, turnkey furnished properties. those are absorbing a lot of that inventory too. So yeah, that's putting pressure on for rent units. But again, you got to be careful because national home builders are now starting to do build for rent communities. And that's putting inventory in play in a lot of markets. So you need to really understand supply and demand. What does that look like in your areas, in your markets? I know Florida, there's a lot of markets in Florida that are correcting from a rental standpoint. You got to look at demographics, positive net migration. Where are people moving to and where are they moving from? So you want to understand those things. If you're going to own rentals, especially out of state, out of your area, you want to make sure you're owning where people are moving to and there is demand for rental and there's not a lot of units coming into the market. The other thing is there's more apartments than there are houses for rent. So if you own houses, there's going to be a bigger demand and you're going to get more of a premium because people want to have a house and they can't buy one because there's no inventory in most areas. Now forget, we got to take Phoenix and those areas off the plate, but in tight markets like mine, where I'm at, a lot of different markets around the country, there's nothing for rent. There's nothing for sale. So if you want to rent something, you got to pay whatever when it comes up. Now to that point, you will reach a point to where you can only rent for so much because people can only allocate a certain percentage of their income to rent, and they'll get to a point to where they just can't afford it. So you want to make sure you're in an area where people, if your rent thesis, if your property thesis is I can bump the rents, you want to make sure you're in an area that will support those rents, based on the incomes, because we're seeing a lot of multifamily where people made these bets that they were going to be able to raise rates and are not able to do it because of the different things we just talked about. New development coming into the pipeline, new apartments coming in the pipeline, renting for cheaper than your value add deal, 1970 vintage, value add that you thought you were going to be able to get more than a new construction. That's just not happening right now in some markets.
No, I totally get it. Now, let's switch gears a little bit because I know you do commercial properties as well. I think commercial is fantastic, multifamily, apartment complexes. So there is one, I guess, thought about that I have about multifamily that I hesitate in doing very much of it because the biggest reason why is when you invest in a multifamily, they call it syndication, where they basically salesmen go out and try to get people to get money to put into a specific deal, and that's their job. Is they're selling the deal and trying to get money to take down the property. Let's say it's a $10 million property. Well, you need to have 20% of that in order to get financing. But here's my dilemma, and you help me because you probably have a way to explain how this works out better. So what I'm not a big fan of is exiting in 3 to 5 years. It's historically about 7 years, but recently, because it's been such a high turnover, eventually this is what it works out. Because all the time they want to exit. Like we want to exit. And so what happens is, let's say you build one apartment complex, then a few years later, the syndicator says, oh, I want to buy that property. And then we're going to pay more because it's worth more. And then we're going to exit in 3 years. Then the next 3 years later, 5 years later, another syndicator comes on top and they pay more. And the next syndicator after that, 3 years later, comes and pays more. Eventually, you get to the very top, and you're at the very end. There's no more money that you can. It's the very top of the market, and then you're kind of stuck with something. Does that sound completely off? But it just seems like you just have to keep finding somebody else to sell it to.
Yeah, so that's a tipping point that we reached, at the end of last year, beginning of this year, primarily because of interest rates. So what happened was those values only kept going up. Obviously, because people were boosting rents like you're doing, raising the rents, and it's all based off your net operating income, but rates were coming down. So as rates come down, cap rates come down, values go up. So, in the multifamily syndication game, largely is a fee-based business. So they're making acquisition fees.
It's a
fee-based business. Yeah, you're a money manager. So you're raising capital from investors. Yep. To do the bigger deals, and you're getting an acquisition fee, you're getting a disposition fee. So the way a syndicator makes money is on the acquisition, on the disposition, and then the delta, the water flow after the investors have been paid back, there's a profit delta on the back end that they split with their investors. So they have to exit. That's the only way a syndicator makes their money other than their fees. So, a lot of syndicators are motivated by that. They just want to do deals because they get fees. Now, what happened is a lot of them, got short-term interest-only loans. They were betting that interest rates were going to come down. Interest rates went the exact opposite way. A lot of people think they're going to come down now in the next, 3 to 6 months. We've been hearing that for a while. They may or may not. The 10 years down right now. Some people say it'll spike again. Some people say it'll come down. Nobody knows for sure. So you can never bank and bet and make your business plan based on an interest rate policy because you just don't know what that's going to look like. But you can, determine what your rents might possibly be if you look at the area, your market, and you can understand that. So, that's why they want to exit those properties and do that. But yeah, it's a constant churn. You got to find somebody that's going to buy either at a higher price than you, or maybe it's institutional money that's looking for a bond play. They don't care. The problem with that is you can get 5% risk-free right now in treasuries and in some banks versus buying a 5 or a 6 cap with risk. So you need a delta. So in order for that to make sense for an institutional investor, I need to get a 6 or 7 cap, maybe even an 8 cap, because there's risk associated with real estate versus treasuries and other things. And that put a lot of pressure on the market. So we're seeing a lot of syndicated multifamily deals, big ones, that are going back to the banks that are being sold for pennies on the dollar. You've seen a lot of the same thing with office properties. Office is taking a big hit, 75% discounts on some of those.
Oh my goodness. With COVID, that proving that you don't have to be going to an office for your job. That if there's anything that COVID proved, it was that people can work.
And it also proved what are the good assets that didn't shut down. Both, housing, people needed a roof over their head. A lot of people thought people would stop paying rent in the pandemic. At scale,
they didn't. Anybody have any issues? Like all my properties,
10% here or there,
I was worried because it was all over the news. It's going to happen. You're not going to get. I was
people didn't want to lose their homes because of the pandemic. They didn't want to have to be forced to try to get out there and move, and they're working from home. So they needed that more than ever. So housing did well. You got to buy groceries. Grocery anchored centers did well. Medical and dental. Some dental clinics shut down, but medical, you got to have medical care and healthcare. Surgical centers, they stayed open and operated. Things like that. You have to have gas. You can own gas stations and lease the property to an operator. You don't have to run it. People need gas still until EVs take over that sector. Storage did well, believe it or not. No matter what, people don't let go of their stuff. They store it. So that always does well. And, beyond that, some restaurants were able to, do okay, but, most of them stopped paying rent. Retail took a beating, restaurants took a beating. So we saw pandemic-proof, economic Armageddon-proof real estate. So now you know what you should be investing in.
Where do you see the economy and the market going? Let's say, not 5 years out, but in the next 3 years. Just give me from your history, from your experience, do you see it continue to rise? Because we know there should be corrections in every market, but we haven't had a correction since 2008. Maybe 2020, they kind of call that, but it was self-inflicted where people had to lock down. But what are your thoughts on the next 2 to 3 years?
Yeah, the interesting thing is, since 2008, we had all that Fed liquidity, quantitative easing, zero interest rate policy. We never saw inflation. So as long as the Fed can juice the economy, lower rates, and you don't have negative inflationary consequences, you're good to go and you're off to the races. So we didn't have any issues at all till the pandemic, because that was a supply side inflation driven. The inflation was driven by the lack of supply, not demand. Not because of, all the wealth that was created. It was because there was no goods to buy, and limited services. So where we're at now is that, the labor market is still very strong. Consumers are still spending. The economy is still humming along pretty good. I can't go out past Q1 because we do know that there's been a lot of forbearance from the pandemic. There's been a lot of different things, pushed forward from the pandemic. Consumers were loaded up with a lot of money. A lot of people made money in the markets and crypto, things like that. So there's a lot of liquidity sloshing around out there that the bills don't come due for until Q1 2024. So once we get into the first quarter of next year of 2024, we're going to get a better understanding of where the consumer really stands, where the economy really stands, where the labor market really stands. We're seeing some layoffs here and there, but there's still more jobs than there are people willing to take them. People are still having to pay more money to get workers in a lot of segments. We still can't hire enough in construction to keep up with demand there. That's going to keep pressure on, new houses, on, commercial construction and things like that. Those prices haven't come down much. So right now, things are looking good, looking robust. The Fed has paused their rate hike campaign and said that they're going to cut rates, at least 3 times next year. So they right now are saying, job done. We got inflation coming down. We're going to continue to work to get towards that 2% target. Everything is hunky-dory, and they're okay with the economy heating up and the bond market coming down, because the bond market is doing the easing for the Fed right now that the Fed doesn't have to do, just like the bond market did the tightening for the Fed at the end of their rate hiking cycle that the Fed didn't have to do, because that eases and tightens, monetary, the financial environment, monetary environment, liquidity environment, right? The raising and the lowering of the 10-year yield. So right now markets are off to the races. They're having a good time. Bond yields are down.
The last Fed announcement. Oh my goodness. I was like, oh my, it just popped. I was like, wow, they're coming back to the races, like you said.
Exactly. So right now, everything looks good. We're in an election year, but that could all change. You could have
you're right. There's
war
so
can
many
escalate
variables.
In Ukraine or in, Israel.
Yes.
Gaza, that can happen. You could have some sort of a big geopolitical event. There could be things out there that we don't know that's lurking under the system. The biggest issues we have are corporate debt that has to be refinanced. And real estate debt that has to be refinanced combined. But, those aren't big enough, fast enough to be systemic like 2008-9 was, so a lot of these things are more slow moving. A lot of people are worried about government debt and that being a problem, thinking that there won't be an appetite for our debt around the world. Well, that hasn't proven true yet, because we're the largest economy in the world. We can print, so the analogy I always use.
You're not seeing any crash any coming or even a correction, like it's going to keep moving along. At least that's what it sounds like.
I don't see a deep recession like we saw in 08-09. Forget the pandemic. We just shut down the country. That's that was an induced thing. 08-09, what a real recession is, job loss at scale in manufacturing, services, industry, construction, manufacturing, service industry. When people are losing their jobs at scale, 10, 20% of the workforce is out of work and can't get a job. Now you got a recession. We're just not anywhere near that. And we're not seeing any signs that we're going to get there right now. There's some signs of slowing here and there, but there's nothing that says we're going to get a real recession where there's going to be job loss at scale and the economy is going to slow. Now, the Fed is seeing some signs. That's why they did what they did. And that's why the bond market's coming down. And that's what's stimulating the economy on behalf of the Fed. The Fed may see, and he did say, hey, I may see, signs of a recession next year. But what does that really mean? Is that negative GDP for a couple of quarters, or is it real slowdown and real layoffs?
Yeah, that's an interesting point. There's so many variables, as well as, in a presidential election year, if there's an incumbent that's trying to stay on, usually they try to make sure that the economy doesn't crash, because they could, if it does, if there's bad things in the economy, their opponent can say, hey, look at what they're doing, come vote for me, all that sort of stuff.
And they left the door open to stimulate because rates are so high. The Fed didn't cut. They don't have to because the bond market is cutting. If something happens, now they can cut and they can stimulate.
I think when you talk about stimulation, if anybody doesn't know what that is, it's literally printing money. It's really what it comes down to. Like if you or I did it, it'd be called counterfeit, but the government does it. Hey, it's great. Let's just keep printing as much money as possible. No matter what, eventually that bill is going to come due. All this money that they printed for trillions and trillions of dollars, it's literally going to come due sooner rather than, it seems like it'll be sooner rather than later, but it just hasn't happened. And it seems like, okay, this year it's going to happen. And then this year,
they've rolled $1 trillion off the balance sheet. They've still got 13 or whatever trillion to go, but they've rolled $1 trillion off the balance sheet, and they're going to continue rolling $1 trillion off the balance sheet. So, that was what I was saying earlier. It doesn't. So there's a theory out there called modern monetary theory, where the government doesn't need to balance its books like we do, like a business does. Then the analogy I use is, if you knew I had an infinite ability to print money, you would lend me and pay you back. You would lend me all the money I wanted, right? So if I said, hey, let me borrow money at 10%, and you knew I had an infinite ability to print that 10% return, wouldn't you just lend me forever as long as I could continue to pay you back?
Then we get into becoming like the Weimar Republic, where to buy a loaf of bread, you're bringing a wheelbarrow full of. So eventually, it's going to come.
But again, you can't compare that because you're talking about a microscopic economy compared to the world's largest GDP. We are the largest GDP. If you look at Myanmar, these other hyperinflation, we're 100 times, 1,000 times their economies.
But you got China and Russia trying to get rid of the dollar, which is not looking good for us. They're already in the process, literally doing it right now. So
that's not accurate either. So that started back in the 1990s. Okay, Brexit or BRICS. That conversation started in the 1990s. That sounds easy, but they can't do that. They would destroy their own economies trying to get rid of the dollar, because what are they going to use instead? If they don't use the dollar, because goods and services, the world economy trades on the dollar. So the number one, they need to figure out, okay, what's going to be the reserve currency? Who's going to maintain that reserve currency? How is it going to be backed? Who's going to monitor and maintain what it's backed with? And whose GDP is large enough in order to do all that, and who is a free democracy that you can trust in order to be able to do all that. So what's happening is the Brexit or the BRICS countries, they're actually going the other way. India pulled out. They actually tabled that whole, new reserve currency, whatever they were going to do conversation. So that's actually been tabled, because if they were to do that, they would just bankrupt their countries instantly, because if they get off the dollar, then everybody who has dollars in their country, it's all of a sudden worthless now, right? And then they still have to trade around the world. And even if you get off the dollar, well, all of the goods and services you're trading are still going to be based on the dollar, because nobody can agree on what is the reserve currency going to be and who's going to maintain it, manage it, back it, and take, custody of those reserves that's backing that currency. So it's not as easy as it sounds. That's why they've been talking about it, since the early 90s. Now,
trust me, it doesn't sound easy at all. It sounds like it's a lot of work.
Yeah. So could it possibly happen someday? Sure. I mean,
it will. I mean, history of the world, like literally empires come and go. It will eventually happen. I'm not saying it's going to happen tomorrow or even like 10 years or 20 years from now, but it will. But the thought that we can literally keep printing money, it's like, well, eventually the money just isn't worth anything. That's really what it comes down to. What is worth things? Gold, silver, real estate, physical metal, things that are actually tangible. That's absolutely worth
chickens
something.
And cows.
There you go. Absolutely. But we could actually live on, man. Great. We could keep going on this. I love talking to you. This has been fantastic, but definitely I want people to know how to find you, how to connect with you, and even check everything you're doing on YouTube and all that good stuff.
Yeah. GregDickerson.com. That's where all my stuff is, all my YouTube, social media handles. Go check it out. GregDickerson.com.
This is fantastic, Greg. Well, I really appreciate coming on the show, giving insights. I love talking to people who have been investing for more than, I don't know, 2 or 3 years. Because a lot of people like nowadays, they're like experts and they've only been investing for 2 or 3 years. Not saying anything bad about them, but it's like you need a lot more breadth of experience to really be able to understand like really where we're going, what's going on, and what has worked and what hasn't worked. So I really appreciate you coming on, Greg.
Yeah, it's business cycles, peaks and valleys. So You need to understand where you are in the business cycle. This is my 3rd business cycle now. Going back, I bought my first property, my house, in 1990. So that we were going, coming off of a peak down into the bottom of that business cycle, late 80s, early 90s. Then it started upwards again, 2008 and 9 down. So here's the thing about, what you just said. So when I started my career, basically 1997 till 2008, 9, all I knew was up only. Everything goes up. Property's only going to be worth more. Ain't nothing going to change because they ain't making no more of it. We all found out that's not true. Markets, economies, they don't, like you just said with the dollar, things don't always go up, and always and forever. We've been living in a very distorted reality over the last, really since 2008, 9, but more particularly since 2020. It's a very distorted reality of the markets, of interest rate policy, of liquidity, of all of these different things. I mean, this is a new paradigm that we're in, and a lot of the old rules don't apply. What you need to understand is good times never last, bad times never last. There's peaks and valleys, and there's business cycles. The most important thing to know than anything else is the top. Where are you in the cycle? And get out, take profits, and be ready to take advantage when it dips. So understand that, know the top, and be able to, position yourself to take advantage of the opportunities when that business cycle rolls over. So that's what I'll leave everybody with.
No, I love it. I remember, I can't remember who, it might've been Warren Buffett, but somebody said, when people are buying, you need to be selling, or you need to be selling when people are buying. Like you just need to be opposite of them, because the herd just will keep running towards it. And then eventually they'll fall off the cliff. But
you want to exit when you want to on your terms, not when you have to on whatever terms.
Absolutely. Greg, great. I really appreciate you coming on the show. Give us lots of great insights, man.
Awesome. Thanks for having me.
And that is it for today. Go ahead and get my free real estate investing course. Text the word rental to 33777. RENTAL to 33777. You can also join my Real Estate Wealth Builders group coaching. Get all my courses. All right, guys, we'll see you in the next show. See ya.